let me just make one more comparison. And this is another myth. Before the Fed was established, the myth goes, the gold standard did not perform well in preventing fluctuations in the value of the dollar. Now, if you take 1800 as a standard, and then look at the 1913 dollar, okay, the year before the Fed started operations, you could actually buy in 1913 a dollar's worth of goods in 1800 was worth, you could have bought for 79 cents. So the dollar actually increased in value under the gold standard. It increased from $1 to about $1.27. You could buy 27 cents more. Okay. And if you look from 1800 to 1896, before we've had a lot of gold discoveries, the dollar was worth $1.22. Now let's look at the exchange rate value of the dollar. Since 1973, against major currencies, which also are inflating, the U.S. has lost 30% of its value. The U.S. dollar has lost 30% of its value against this basket of currencies, meaning that we're inflating at a higher rate. If you take a very strong currency like the yen, the U.S. dollar used to be worth 360 yen. It's now worth 80 yen. Okay? It's lost 75% of its value against the yen currency. How is this a good job? I don't get it. And neither does the Fed. All right, let me just say a few words about another myth. The Federal Reserve was created in order to protect the public interest by preventing financial crises and stabilizing the economy. Let me just tell you a little story. I'll try to make it as brief as possible. After the Civil War, the U.S. banking system had a cartel. It's called the National Banking System. What that did was to really centralize control in the Wall Street banks, though it did not have total control. It definitely made it easier for them to earn income by inflating the money supply and then lending that created money out at interest. But what would happen was, every time they created an inflation, okay, prices would rise, banks would lose their gold reserves as people began to buy goods abroad and had to pay in gold, that is, they would buy more imports. And at that point, the banks would have to stop inflating. And so some of the banks would go bankrupt because some of their borrowers could not pay the money back because of the recession that was occurring. The banks would stop inflating, raise interest rates. You have business failures and a failure of the businesses to pay back their loans. People would see this and they would go and demand their gold to be redeemed for the checking account money or the currency. Okay. This caused panics of 1873, of 1882, of 1890, of 1893, and in 1907. So we had a number of panics. Now, this is usually blamed on the gold standard, but the point was that these panics occurred because the gold standard restrained the banks from continuing to inflate. So the gold standard was called the golden handcuffs. Every time the banks became too inflationary, they faced the loss of gold reserves as people withdrew their gold, fearful that the banks would fail. So bank failures were a good thing. Now, of course, the Wall Street banks didn't think that was true. They began to complain about something they called the elasticity of the currency. The currency is not elastic, meaning there's no one there to inflate reserves so that we can pay back our depositors when they come in demanding reserves. So they began to push in the 1890s for a central bank, which they called a lender of last resort, basically an inflator of last resort. There was also a movement to sidestep the banks by William Jennings Bryan. He wanted to monetize silver. He wanted inflation, but he didn't want it through the banks. So the banks were worried about the panics. They were worried about the loss of control that would have occurred if the government began to inflate directly by issuing treasury notes against silver. So the bankers got together and they began to push this idea that we needed a central bank. But the American public was extremely hostile to central banking and to monopolization. You still had the Jeffersonian and Jacksonian tradition. Okay? President Jefferson had destroyed the first bank of the U.S., which was a quasi-central bank, and Jackson fought a long and bitter war to destroy the second bank of the U.S. in the 1830s, which is also a quasi-central bank. So that was still in the American psyche. So how did the bankers get this whole thing across? To make a long story short, this was a progressive era where enlightened businessmen made alliances with professionals, MDs, clergy, academics, all people who wanted to professionalize their occupations, and in return get special privileges from government to keep other people out of their profession, and to get jobs and grants from government, especially academics, economists, sociologists, and so on. So what they did then was to get together and come up with this line. And the line was, government planning and regulations are necessary to protect the public interest against which is representing consumers, workers, and farmers, against exploitation by big business monopoly, and to save capitalism from the excesses of the free market. Okay. Well, the first movement to do this failed in 1902. They tried to get a bill across, but the small banks that were outside the cartel killed the bill. But then in 1910, they began to do it again, or actually 1907, after the panic of 1907. And so for 3 years, they beamed propaganda at the American public. This all culminated in 1910 in a week-long infamous conference at Jekyll Island, in which 6 bankers, academics, and politicians got together. They were all connected to the Morgan and Rockefeller financial empires, and they hammered out a bill, which 3 years later, in almost unchanged form, was passed and signed by President Wilson, and that was the Federal Reserve Act. Okay. So that was a great Christmas present that he gave us. Okay. See, he signed it right before Christmas. All right, now let me talk about the myth that the Fed does not print money, which is what Bernanke had told us on 60 Minutes interview. Instead, it controls interest rates, okay? Or it engages in quantitative easing. Well, it pains me to admit it, Bernanke is technically right. The Fed does not literally print money. It creates money through a fractional reserve banking system. Which means that each bank, all your banks, hold by law a minimum of 10% of your banking deposits, 10% of your checking accounts, and 0% of your savings accounts. They can then loan the other 90% out. So if you deposit $10,000 in your checking account, and by the way, if you move $10,000 anywhere, of course, you have to fill out all these forms today. And that's like the war against cash, but that's another story. So if you put that $10,000 in a bank, they hold $1,000. They keep that in their ATM machines and their vaults on reserve at the Fed. And then the other $9,000 they loan out. So you have $10,000, and then when that bank loans the money out, and the borrower spends it on something, a small businessman spends it on expanding, let's say, his dry cleaning operation, that money then is placed by his suppliers into the banks and creates another checking account for another $9,000. Now you have $19,000. That bank then holds $900 and loans out $8,100. That's redeposited. Okay? So now you get a multiple expansion or multiple deposit creation mechanism operating under fractional reserve banking, which increases every Fed dollar or every dollar that the Fed injects increases up to a maximum of 10 times. So if the Fed injects $100 million on a given day into the bond markets by simply buying bonds, I'll talk about that in a moment, what happens is that becomes, over time, can become up to 1 billion new dollars of checking account money in the economy, okay? So basically, whenever fractional reserve banks make any kind of a loan, they create money, okay? It also causes a redistribution of income from those who get the new money first to those, or to those who get the new money first, from those people like you and I who may not get that new money for another 18 months. That is, prices begin to rise, our incomes stay the same, our salaries stay the same, we have to pay the higher prices. If prices rise by 10% over that 18 months, your real income has shrunk by 10%. Okay. And it also artificially reduces interest rates, because when the banks loan this money out, there's extra money, a greater supply of money to be loaned out. The only way you get people to borrow that additional money is to lower interest rates a little bit. And that causes bad investments and overconsumption and causes recessions. Okay, so how does the Fed actually print money? Well, they actually do it about 3 blocks from my office. I work at Pace University in New York City, business school right almost on Wall Street. So the New York Federal Reserve Bank, every day between 9 and 11, it's called Fed time, they hold an auction in which they buy bonds, okay, and up until a few years ago, that's all they bought was government bonds, but since then they've been buying other things. But they buy bonds from 30 selected privileged banks and bond dealers, Goldman Sachs, for example, and others, okay? And let's say they buy $100 million worth of bonds. Now let me step back for a moment. Since 1980, the Fed can buy literally anything, okay? I sold an SUV last year, a used SUV, okay? It's an epic tragedy if my wife has to keep a car more than 3 years. So we had to sell the SUV. So I sold it for $10,000. Now let's say the Fed, as part of its quantitative easing program, was buying SUVs. What they would do is simply print up a check, sign it at the Fed, write it out for $10,000 to me. I would then deposit it in my bank, and presto, the bank now has $10,000 that it can loan out. Now the Fed wouldn't even really write me a check. What it would really do is just hit the keystroke, make an electronic entry, increasing my bank's reserves by 10,000. The bank would then increase my account by 10. It would all be done electronically in cyberspace. Okay, so the money is conjured up out of nothing. Now, in the real world, during Fed time, every day, they buy tens of millions, if not hundreds of millions of dollars worth of bonds. From 2001 to 2005, this is what created the bubble, by the way, the Fed increased the money supply by $2 trillion, from $5 trillion to $7 trillion. So at the beginning of 2001, it was $5 trillion. By the end of 2005, it was $7 trillion. That works out to an increase in the money supply of $1 billion per day. Just the back of the envelope calculation I did last night. They created $1 billion a day. Well, of course asset prices went up. Are they idiots? What else is going to happen to this money? Okay? So housing prices, stock prices went up and so on.